Is it finally time to buy 3M stock? The stock has rolled over since the COVID. The stock has rolled over since the 2018 highs and has since rebounded about 50% from the COVID lows. So we have to ask ourselves, is 3M a worthy addition to our portfolio? Will the rebound continue or will the stock begin to decline from these levels? Keep watching to find out, as we'll be talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, let's discuss 3M. They've just reported earnings at the time of this recording on Tuesday, January 25th after market hours, and they ended up coming in at $8.5 billion on revenue for the quarter. But that's essentially flat year over year. Earnings per share came in at $2.31, which actually beat expectations by about 29 cents. Looking at this from a full year perspective, revenues came in at about $35 billion, and earnings per share are at $10.12. Now, despite beating Wall Street's expectations for the past few quarters, which demonstrates their ability to produce consistent cash flows from a profitable and stable business model, is all of that enough to get you to add 3M to your portfolio? Well, looking at their 2021 financial results, we can deduce that for 2022, we'll see yet another profitable year despite the logistic and global supply chain challenges. Actually, since they reported earnings this afternoon, the stock hasn't reacted, which is interesting, but I'm more curious about what the stock will do over the next 3 months, but we'll talk about that here in just a second. First, let's talk about the stock price. We'll do a business analysis, we'll take a look at the fundamentals, the dividend, and then you'll see whether or not we as retail investors can find better businesses to add to our portfolios. And if you enjoyed this video and the investing perspective, please click that like button to support the channel, and if you haven't already, consider subscribing. Looking at the stock price over the last decade or more, 3M actually did pretty well over that period of time, up over about 250% or so from the 2009 lows. However, we are back to 2015 levels despite the rising dividend, and those who bought in 2018 are even worse off as the stock has declined about 30%. So why is the stock declining if they're beating earnings estimates? Well, if we take a look back at 2019, we can see this is due to weak consumer demand in Asia and most importantly China. And since 2019, we've actually seen a little bit of progress for Asia, where we actually see some growth, but the issue is after the foreign exchange translation, we come out to negative total growth. But this is due to the contraction in China's economy, which is undoubtedly the world's most important industrial country, and has led to major headwinds for 3M. And seeing as the downturn in China's economy began in the second half of 2017, its full impact wasn't seen until the US-China trade war, which really kicked off early 2018. Consequently, it was at this same time that 3M shares began to fall from the all-time high of over $250 to roughly the $175 presently. That being said, if you've gotten in anywhere under $160, you don't have much to worry about, as this business has proven itself to be a compounder, which happens to come along with the rising dividend that acts as the cherry on top. Let's not forget, this business is recession-proof to an extent, and evidently it's pandemic-proof. They've actually increased their earnings since the pandemic due to their line of business. And this is why we've seen strong rebounds in the stock from these lows. The PE ratio is currently sitting at about 17, which indicates about a 5.8% expected return. Tack on an additional 3% dividend yield, and we are already at about an 8 to 9% return, which is not bad at all. But let's come back to that point in just a minute. First, let's take a look at their financials. So revenues are earned from its four segments. There's the safety and industrial segment, so think safety tools and equipment. There's also the transportation and electric segment, the healthcare segment, and finally the consumer segment, which is sales from home and office supplies and such. If we scroll back up to the income statement, we can see revenues came in at that 8.6 billion number, and this is slightly higher than a year ago where they received about $8.5 billion. So a relatively insignificant growth year over year, just 0.3%. But what is growing is their cost of sales. As you can see, this came in at about $4.7 billion, which is actually up from the $4.4 billion 1 year ago. So in order to produce the $8.6 billion worth of revenue, you had to pay 4.7, which honestly isn't bad at all. And is why this is actually a relatively high margin business. Now, while this isn't a conglomerate like Facebook, Microsoft, Visa, or MasterCard or something, their margins are still good and demonstrates 3M's competitive advantage because not many businesses can consistently operate with 40% margins, and it shows 3M's ability to produce their operating income at a higher level than their competitors. The only issue is, while their revenues are flat, their cost of sales have grown $300 million, which is why after we've accounted for salaries, research and development, we come out to about $1.6 billion here in operating income. This is down $200 million from a year ago. And so this isn't a great sign, but it's also what you can expect from an older and maturing business like 3M. And this is also part of the reason why the stock is down from those 2018 highs. Now, you pay some taxes, some other expenses, and you are at $1.3 billion in net income. Again, slightly lower year over year, so you can definitely find more attractive profit margins elsewhere, but margins aren't the whole story. If we scroll down here to the balance sheet, we can see that from a balance sheet perspective, cash and total current assets are stable and growing. We see some PPE, a decent amount of goodwill, and we are at $47 billion in total assets. Deduct some short and long-term debt, some pension liabilities, and we are at $15 billion in shareholders' equity, which is actually up 17% year over year. Something to note, the total current assets are essentially equivalent to the total long-term debt, which is a good sign, as we know they can easily afford the debt, so there's no issues that I have with the balance sheet. Everything looks clean. Now, onto my and likely your favorite section of the financial statements is the cash flow statement. Typically, we begin with net income. We get to add back in depreciation, amortization, add back in some other non-cash costs. Okay, and we get to this cash provided by operating activities of $7.4 billion. However, 3M have decided not to include some of that information. Anyway, we deduct the $1.3 billion in capex, and we are at $6 billion in free cash flow for the year, which is in line with what they've presented in their presentation. On a market cap of $100 billion, that's a price to free cash flow ratio of about 16, which makes 3M too expensive for me as I looked for a higher rate of return. But if you're okay with a 6% cash flow yield, this might be a great investment for you, as 3M has proven itself to be a compounder over the years, and I do expect a turnaround from these levels should they improve their international sales as they plan to do. Okay, so what are they doing with that $6 billion of free cash flow? They're paying down some debts, they're repurchasing shares, and they're also paying a dividend. So overall, not a bad business to add to one's portfolio and should see decent returns from these levels. So at the end of the day, we have a focus on debt repayment, positive operating free cash flow metrics, which lead to a growing dividend, and share repurchases, which will push the stock even higher once a full recovery is in effect. But we're looking at around an 8 to 9% return from these levels. This is not including the buybacks, which should push the stock even higher. And if you're good with a stable business that will compound and produce stable cash flows for the next few years, then 3M is something to consider. But if you're looking for high rates of return, this may be a stock to trade instead, and this is something we can capitalize on the rebound, and really that's the risk and reward with 3M. So let's take a look at the stock to see if there's any technical setups that we can play. And so on my screen here, you can see we have 3M, and it's kind of just in this range here since about September. It seems to be finding resistance up here at $180 per share, and it finds support down at $170 per share, and it's kind of just been range bound in here. And as you can see, after this earnings release, we can see that it's back to this $170 price point. So we're at actually a good inflection point as to figuring out where we're going to go from here. So there's quite a few scenarios that we can see from these levels depending on how Wall Street reacts to their earning release. We could either see some more choppiness, some range-bound activity. It's also possible that we can see some consolidation before breaking up, and through the resistance up there, assuming the recovery kicks in and is in full effect. Or we could also possibly see the stock trend downwards and break through these levels. So until we see a clear indication or clear sign that any one of these three scenarios is going to play out, we kind of just have to play what has been going on, and that has been the fact that there's been some support here. So immediately what I'm thinking just right off the bat is, because of the fact that we do have some support here, and it's shown that it's been a great area, a buying opportunity. If you are interested in 3M, yeah, this is a great opportunity to pick up some shares. But at the same time, if you're not too sure about picking up shares with 3M, this is another great opportunity. You can sell some puts. Maybe you could purchase some long call options, and we can look to see if we will find the recovery or the rebound up until this 180 price point. Other than that, if we're going to end up breaking below this $160 price point, we'll probably look to see this 150 area hold up as support. before we see ultimately down here at this 130 levels. I personally don't think that's too achievable for the immediate future. It really depends on what's going on with the Fed, the interest rates rising and whatnot. But assuming we see a recovery from here, yeah, we're probably going to get through this 180 level and push back up into this 190, $200 level. Other than that, thank you for watching until the end. I hope you enjoyed this video. If you're interested in this type of content, please leave a like and consider subscribing. Until next time.